Hello, I'm Kyle Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're going to be focusing on one of the headline measures announced by Chancellor Rachel Reeves in the autumn budget, which was the decision to scrap the inheritance tax exemption on unspent pensions from April 2027. To explain what this all means is Craig Rickman, personal finance editor at Interactive Investor. So Craig, I'm going to pass the baton to you to explain to our listeners what the headline implications are.
Yes, well, this is a big change to the way pensions are taxed. In the lead up to the budget, there was a lot of speculation about how pensions might be reformed. A lot of the rumours homed in on whether tax-free cash would be reduced or potentially scrapped. That didn't happen, which will be a relief to some savers. But as you mentioned, from the 6th of April 2027, the IHT exemption on unspent pensions will be removed. So simply put, this means that your pension savings will form part of your estate on death and could be taxed by up to 40%. That's not the case right now. Pensions are considered outside of your estate for inheritance tax purposes. This doesn't necessarily mean that whoever inherits your pension will pay inheritance tax. There are still some lifetime allowances and exemptions that you can use to mitigate or even avoid a potential inheritance tax bill. But the more we unravel about the details here and the implications, it's becoming clear that the tax penalties on some families could be really heavy. In terms of how many could be affected by this, the government estimates that around 49,000 estates a year that have pensions will face an inheritance tax bill, and this comprises 10,500 which will be dragged into the inheritance tax net, and 38,500 who will face a larger inheritance tax bill as a result.
However, if you're a spouse or a civil partner, then you will not fall into this inheritance tax trap. That's correct, isn't it, Craig? It's when you're trying to pass wealth down the generations to your child or children, that's when they may be subject to paying inheritance tax on unspent pensions.
Yeah, that's right. That's an important point to cover. So yeah, the spousal and civil partner exemption will remain, which means that your husband and wife can inherit your pension free from inheritance tax. So if you're married and leave everything to the survivor, it's only on the second death, as you say, when, for example, the money is left to children, grandchildren, nieces and nephews, that inheritance tax may apply.
And there's also allowances. So it's only if you're above the allowances that are in place for inheritance tax. Could you talk us through those?
Sure, yeah. So working out your specific lifetime tax-free allowance or allowances is an essential part of any sort of sound estate planning exercise. And this will perhaps become even more important in light of the IHT exemption on unspent pensions set to be removed in 2.5 years' time. So everyone gets 325,000. That's called the nil rate band, a rather monstrous piece of jargon. So everyone gets that, and if you own a home, you could pass down a further 175,000. That's called the residence nil rate band. So this means the potential tax-free allowance for single people could be £500,000, and then for married couples and civil partners, that would double up to £1 million, assuming that you leave everything to the survivor on death. But interestingly, not everyone qualifies for the residence nil rate band. There are some sort of criteria to be met here. So the first is the home must be left to direct descendants. So this is children, grandchildren, stepchildren, foster children are included in that as well. So that's the first. The second is the residence nil rate band reduces by £1 for every £2 your estate exceeds 2 million. So for single people, it's wiped out if everything you own is worth more than 2.35 million. And this is 2.7 million for married couples, because the allowance doubles up, assuming you leave the home to them.
There's also the income tax rule with pensions. Essentially, if you're passing on your pension and you die before the age of 75, then there'll be no income tax to pay for those that you've left your pension to. However, if you die at 75 or over, then there will be income tax to pay by those that receive the pension.
Yes, yeah. I mean, that's a really interesting point, and that's one of the things that's emerged sort of after this is the potential of a tax double whammy Assuming someone dies after the age of 75, whoever inherits the money could pay both inheritance tax and income tax. So, let's look at an example. Let's say that happens, and the full value of unspent pensions is subject to IHT. Then the combined rate, looking at 40% inheritance tax, and then income tax could be either 52%, 64% or 67%. So 52 is of the inheritance tax added to the basic rate of income tax, which would be 20%. 64% is if whoever receives it pays higher rate, so 40% tax, or 67% if they pay additional rate tax. So some potential painful tax rates here, and they could in some instances, in fact, be even higher. So if the withdrawal puts you into one of the tax traps, where you pay either a charge on child benefit or lose your personal income tax allowance, it could be higher. Or if your pension savings trip your estate above £2 million and cause you to lose the 175,000 residents nil rate band. So to reiterate, the estate planning aspect here has become crucial. But this is a tricky task at the moment, and that's because the tax implications are vastly different depending on whether you pass away before or after the 6th of April when the changes come into force. So again, if you were to die before that date, there's no inheritance tax on pensions. If you die after, IHT will apply or could apply. So really, really tricky, as most of us don't know when we're going to die.
And what about those that are unmarried? I mean, we've mentioned that before, that if you are a spouse or a civil partner and the pension's passed on to you, then there'll be no inheritance tax to pay. Is the position different for those that are not married?
It is. So unmarried partners, unmarried relationships is the sort of one of the groups that could be worst affected by this. So unlike marriages and civil partnerships, you can't leave everything to your better half tax-free. They could pay inheritance tax on what they receive. And interestingly, with the residence nil rate bands, the extra 175,000 that you might get for owning a home, if that home is left to the survivor of the unmarried couple, it can't be claimed on the first death. So in this scenario, the most that they could leave, the person who passed away could leave tax-free is 325,000. So what this means is anyone with a modest home and a modest pension will inevitably leave their partner with an IHT bill, and one that could be sizable. So now I'm not suggesting that any unmarried couples tie the knot for the sake of tax, but it's really important to be aware of how this change might affect you and your loved ones.
Well, time will, of course, tell whether more people say I do for inheritance tax purposes. How else do you think, Craig, there may be changes in behaviour for people that are looking to pass their wealth down a generation?
Well, I think it will inevitably cause lots of people to rethink their estate planning and retirement strategies. Some people have been using pensions for the IHT swerving advantages. So those in that group may need to consider a plan B. So what sort of things might we see? So, I mean, we could see more people drawing down on pension assets sooner than before, and either spending the money or gifting it to younger generations. This is one area where, people do need to tread a bit carefully because pension income is taxable. So if the withdrawals that you make trip you into one of the higher rate brackets, 40%, 45%, then, the potential IHT savings could essentially be wiped out. So it could be a kind of futile exercise. But something that may become more appealing is to make third-party pension contributions for younger generations, children or grandchildren, as they can get tax relief at their marginal rate of income tax on anything that you pay into a pension for them. So, for example, if your child is a 40% taxpayer and you pay into their SIP, they'll get basic rate relief up front, which will give it an immediate boost and can claim back a further 20% of the total contribution on their tax return. So that might sound quite attractive if you've got surplus pension income and you're worried about IHT. One thing to be careful about here is that, if your children have already amassed sizable pension savings, you could just be kicking the inheritance tax can down the road. In this instance, you could always skip a generation and gift the money to grandchildren into either something like a junior SIP, and again, get a tax boost up front. Or if you'd like to support your grandchildren's more sort of immediate goals in early adulthood, then you could always top up an existing junior ISA that they have. So I think they're some of the things that we may see.
So Craig, you've provided plenty of food for thought in respect to how those who may be impacted by this inheritance tax rule change on pensions can potentially get ahead of that rule changing. Do you think those that may be caught by this need to prepare now, or can they wait, given that it's not coming into force until April 2027?
Yeah, well, I think, first and foremost, before you sort of do anything else, before you start, giving money away or changing up, what you were doing previously, it's important to revisit your existing estate planning strategy, especially if you intended to use your pension savings to leave any kind of legacy. As you've noted, we have until April 2027 until the IHT exemption on pensions will disappear. But reviewing things as soon as possible isn't going to do you any harm. There's still a bit of confusion around what might be affected, which pensions might be affected and which may not. The government has launched a consultation, which is due to end on the 22nd of January. So hopefully we'll get some clarity shortly after that, because otherwise it's kind of tricky for people to plan ahead. But again, there's nothing stopping people from sort of starting the process now and getting on top of it. I think we should also mention that the IHT change on pensions wasn't the only big change to inheritance tax that we saw at the budget. Rachel Reeves also unleashed changes to AIM shares, tightened the rules there, to businesses and farms, and also extended the threshold freeze on the tax-free allowances, so the nil rate band and the residence nil rate band. That's been prolonged till 2030. So it's not just your pensions that might be affected over the coming years. To try and end on some kind of positive note, because this is, some of this is a bit bleak, inheritance tax will still be one of the easier taxes to reduce or avoid, although we must note the task has become harder or will become harder as a result of the budget. But I think the thing to do now is to take the time to consider or reconsider your plans and seek some expert tax and legal advice if you can.
My thanks to Craig, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, leave us a 5-star review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your money on the Interactive Investor website at ii.co.uk. And I'll see you next week.